Hey everybody, it's Jeff, and this is another weekly update of the silver and gold market. If you didn't watch the first one, I focus on the key factors affecting markets. I trade commodities on a regular basis, and I've really narrowed it down to these four, the things that matter most and what moves gold price. And I know most of you guys watching are probably stacking the physical, but it's extremely important to watch the paper market as well. And the hedge funds are huge influencers of that. I have a video of how JP Morgan manipulates or has manipulated gold and silver. I don't know if they're technically doing it. I'm sure they are to an extent, but knowing what they're doing is vital. So I'd highly recommend check in every single Friday. I'm going to post this video to keep yourself posted. So let's jump right into it. Starting with silver, these really are the four key factors here, and I'm going to use APMEX, their 1 ounce BU American Silver Eagle, as the kind of core update to what the physical market is selling for. And as you can see on the bottom row, when I printed this, the silver spot price was 27.33, which was largely unchanged from last week. So it's essentially gone nowhere, as has the spot silver eagle, which is actually a good thing. As you could see, silver premiums jumped from $5 to 12 on that infamous Sunday where there was a short squeeze shortly after the GameStop saga. And the fact that it's been able to stay at a $12 premium, and we're still hearing extremely strong demand throughout the local dealers is a really good sign. And actually, the hedge funds, as you could see from January 29th to February 12th, were actually slowly liquidating their length. They were long 43,000 contracts on January 29th, got to a low of 37,000, and they actually bought week over week, which is an extremely good sign. That's a bullish sign, in my opinion, simply because it's telling you the funds are realizing that the play for now is higher prices. Looking at the futures chart, this is essentially a bullish looking chart. Any chart that has higher lows and higher highs is supportive, and this has obviously trended from lower left to upper right. It's obviously in somewhat of a choppy consolidation pattern. What would be a really bullish sign is if we could somehow break above $30, you get a lot of technical traders coming in and buying that and really pushing futures up. Given the fact that the spot physical market is trading somewhat regularly for $35 to $40 an ounce for silver, it tells you how undervalued the paper market is, which is why I'm certainly bullish on it. The US dollar is a major influencer. It obviously the trend has been upper left to lower right. It's been down, and that seems to continue. It struggles on rallies. Each rally seems to have hit a lower high. And again, we're in somewhat of a consolidation for the last 2 months, but the chart pattern is still lower, which is supportive to gold and silver. So boiling it down, the key factors, the physical market premiums are definitely bullish. I would say the hedge fund position is neutral to bullish, simply because it looks like maybe they're starting to buy now. The US dollar index is still bullish. It hasn't hit new lows, but the trend is still lower and the charts are bullish. So I'm still very optimistic on silver prices. It might take a little bit of time to move higher. And I think the biggest upside right now is probably in the paper market. Jumping to gold. Gold's more interesting this week. As you could see, gold spot prices continue to trade lower, down to the lowest level so far in tracking this is 1781 as I print this. However, the premiums are trading higher still. You could see when we started tracking this on January 29th, the gold premiums were $120 an ounce over spot for a 1 ounce gold eagle, and now they're 170. And more importantly, as you see the hedge fund position, for whatever reason, they're getting out of gold. And a lot of people are essentially guessing they're getting out of gold and into Bitcoin. I actually consider the fact that the funds are liquidating and premiums are getting stronger as actually a bullish contrarian sign. And you look at the paper chart, this is really important. Futures traded to a key level, and as of now are holding that key level. It's around 1765 an ounce. And you can see it was right at the end of November lows. And we bounced off those, traded all the way up to 1950 an ounce before retesting it now. So holding that 1765 is absolutely vital. if for some reason we take it out, I would guess strongly these funds will liquidate even more. But knowing the hedge funds, as I actually talked to some of them, they're probably going to sit and wait just to see how the futures market develops here. So boiling it down, physical market premiums are clearly supportive to prices. The hedge fund positions, in my opinion, I think they're contrarian bullish because they've been selling even though the physical markets remained strong. But obviously, there's a neutralizing impact that if they want to keep liquidating their position, it's going to put a weight on the futures market. But the fact the charts are bullish at this moment, as is the dollar index. So that's all I have. Thanks for checking in. Again, I put this out every week, so definitely want to make sure you subscribe to stay tuned. Take care.